Hello and welcome to the April 2016 Downtown Pittsburgh IBD Meetup presentation. My name is Eric Rossi. I'm a co-organizer for this meetup group. And if you're not a member of the meetup group, or if you don't know where to find the meetup group, there's a link here on the first slide that can tell you how to get to that page. So the mission statement for this group is to educate individual investors about the CAN-SLIM investing strategy. This is a strategy that was developed by Bill O'Neill, and it's now promoted by a company called Investors Business Daily, IBD for short. So we're trying to identify the best educational material from books, articles, webinars, etc., to save you time from having to go out there and search for all this information. And a disclaimer, this presentation is educational in nature, and it should not be construed as recommendations to buy or sell securities. Investing in stocks does carry risk and can result in loss of your capital. I'm a non-professional volunteer investor, and Investors Business Daily, IBD, and CAN-SLIM are registered trademarks of Investors Business Daily, Inc., and Meetup is a registered trademark of Meetup, Inc. The topics for this month, we're going to go over the market dashboard as we've been doing the past several months. We're going to have a back to basics section where we'll cover a chapter from Bill O'Neill's book, How to Make Money in Stocks. We'll talk about setting stops for your stocks after you buy them. Then we'll go through a market analysis, and then we'll conclude. Okay, so here's the market dashboard. The IBD big picture right now is uptrend under pressure. It's been there for about a week and a half, so this gets a yellow indicator. The uptrend health, this uptrend is pretty old right now. It's over 2 months old. You can see it's 73 calendar days. So the longer these uptrends tend to go without the market going into some kind of small correction, the more likely that the uptrend is going to roll over pretty soon. So this gets a yellow because of the length of the uptrend. Distribution days. The distribution day count has increased the past week pretty substantially. So right now we're at 6 for the S&P and 7 for the NASDAQ. So this gets a red. We've also had a cluster of distribution days. There's been about 4 in the past week, which is not a good sign. And we'll look at that during the market analysis portion. The Fed activity, the Fed raised interest rates in December for the first time in about 7 years, and we are expecting more increases in 2016, although as time goes on, it's looking less and less likely that there's going to be an increase. Right now, I think the consensus is that the Fed will increase rates one more time this year, but global conditions between Japan and Europe is kind of persuading the Fed to hold off on this. But this still gets a red because rates are increasing, or there's at least talk of them increasing. So the S&P 500, right now it's above the 50-day moving average. It's slightly up for the year, and the accumulation distribution rating from IBD is a B-, so that gets a green. The NASDAQ is not faring so well. It's trading right about at the 50-day moving average. It's down for the year, and the accumulation distribution in the past week has dropped from about a B minus to a D plus, so not a good sign. The IBD 50, I'm giving a yellow just because it's still a little uncertain right now. It has been on the decline with the regular market indices, although volume has not been very high, and we'll look at that during the market analysis portion. But it is at the 10-week moving average. It's still below the 40-week, which is a sign of weakness. It's down for the year. It's down more than the NASDAQ and S&P. And so it's getting a yellow, but if it starts trading below the 10-week, I'm going to put this to red for next month. The last bull market we had started in March 2009. So given the length of that bull market and the fact that it looks like we may be transitioning into a bear market. It's hard, no one can say for sure right now, but it looks likely because this bull market's been running for 7 years now, which is the longest bull market we've had in the past 36 years and maybe even longer. So this gets a yellow because the bull market's been going on for so long. I think it's a little early to say if we're transitioning into a bear market, but I could go red on this. It's kind of a judgment call. The last bear market ended in February of 2009. So given that that was more than 5 years ago, I gave this a red because the longer we go without a bear market, the more likely it is that we will go into a bear market. And intermediate corrections, which are smaller corrections that are generally around 10%, 15%, this is the number of these in the current bull market, which has been going since March 2009. So we've had 9, which is a lot of intermediate corrections. So this gets a red. Okay, I'm calling this portion Back to Basics. And this is a review of Chapter 10 from Bill O'Neill's book, How to Make Money in Stocks. And you can see what that book looks like right there in the middle. And Chapter 10 is about when you must sell and cut every loss without exception. And this is going to dovetail into the next part of the presentation, which is how to set stop losses for your stocks. Bill O'Neill talks a lot about some of his mentors in investing, and some of these people include Gerald Loeb, Jesse Livermore, and Bernard Baruch. So it's a good idea to check out their books as well if you're into reading about investing. But Bernard Baruch was a famous market operator, and he stated that if a speculator is correct half the time, then you're hitting a good average. And even if you're correct 3 or 4 times out of 10, it should yield you a fortune if you cut the losses quickly. So this goes to show that as a stock investor, you should really expect that a lot of your stocks aren't going to work out. Even if you buy them perfectly and you follow all of the guidance in Bill O'Neill's book and in IBD, you're still going to be wrong and lose money most of the time, actually. So the key is just to cut those losses small and then let your winners run so that hopefully your profits outweigh your losses. And you only need one. If you get one big winner in a year, that can really offset many small losses. For example, if you would have caught Ambarella last year or Skechers or one of those stocks that did really well, that could have made up for many losses if they were small losses. So you also want to use a 3-to-1 profit to loss ratio. And this can fluctuate based on the market conditions. So if you're taking profits at 20 to 25%, which is normally recommended by IBD in a strong bull market, then you want to cut your losses at about 7 to 8%. And a key point here is or less. So you don't have to wait for a stock to get to a 7 or 8% loss before cutting it. And I find myself as time goes on, if a breakout doesn't work on the first day, I might just drop the stock that day for a 2 or 3% loss and then be ready to try it again. The advantage of cutting your losses faster is that then if the stock tries to break out again or it goes through your buy point again, you can buy it again. And I'm finding this right now that at least you tend to have to buy a stock maybe 2 or 3 times before it works out and you see a gain. A lot of them are not breaking out and just running the first time. So in this market, I'm shooting for about a 10% profit amount because just a lot of stocks aren't running 20-25% over the past couple years because the market's been very trendless and choppy and sideways. So with a 10% profit ratio, I'm cutting my losses at 3% or less. And the secret to winning big in the market is not to be right all the time, but to lose the least amount possible when you are wrong. So losses are inevitable as a stock trader, and anyone who tells you that they don't take losses in the market and all their positions are winners is lying. That's just the bottom line. It's inevitable. People like Bill O'Neill, Gerald Loeb, Jesse Livermore, all these guys made millions in the market, and they all said that they took losses pretty regularly. O'Neill found that only 1 or 2 out of every 10 stocks that he purchased turned out to be truly outstanding. So this is where cutting losses quickly comes into play, because he would funnel his money into these big winners, and he would keep adding to them as they went up in value, and as they formed new bases, and as they would say bounce off the 50-day moving average, as they would form new add-on formations like a 3 weeks tight. So he would keep adding money to these big winners and hold them until they gave him a reason to sell. And that could be a number of weeks, it could be months, it could be years even. But the way he would do this is he would sell the laggard performers in his portfolio. So the other 8 or 9 stocks that were not outstanding, he would sell the worst one if he wanted to add to one of his best ones. And a good phrase to live by is to take your losses quickly and take your profits slowly. And a lot of amateur investors, when they start off, they really do the opposite of this. When they have a gain, they're afraid it's going to go away, so they'll take gains quickly. And then when a position goes to a loss, people psychologically don't want to sell for a loss because your ego can get in the way here and your pride. So amateur investors, when people starting off, tend to let the losses start to build and get bigger and bigger until they're so disgusted with the loss that they cut it. And a lot of times that's exactly when the stock starts to rebound. Never average down in price. And Bill O'Neill calls this throwing good money after bad. So if a stock's going down in price, again, this is an amateur move that a lot of new investors make, buying the stock as it declines in price because they think, oh, it's cheap now and it's going to come back up, and by averaging down in price, I'm reducing my losses. But a lot of times this just doesn't work. A stock that's declining tends to keep declining, just like a stock that's increasing tends to keep increasing. And don't justify holding on to a losing position longer than you should. Here's some of psychological reasons that you might justify this to yourself. You might say, well, I'm a long-term investor. I'm going to hold this stock for 2 or 3 years till it comes back. Well, the thing is, there's no guarantee that it's going to come back. It may continue to decline, and you could be sitting on an even much bigger loss 2 or 3 years from now. And another thing that amateur investors tend to say is, oh, well, they're just paper losses. Well, again, this is foolish thinking, because they're not paper losses. If you were to close the position right now, guess what? You're going to incur that loss. And that loss is going to become very real very quickly. If you're getting a nice dividend on a stock, that is very unlikely to make up for a large loss. So even a stock that's getting a really good dividend, it's not a good idea to justify holding on to a loser because you want the dividend. Also, don't hold on to a losing position just because you love the company. You may love their fundamentals, you may love their story, and I'll give you an example of one that I really love is Mobileye, and I've been watching this stock since it went public, and I love the stock, but right now it's just not performing. The earnings aren't there, the stock performance is just not there. So I'm still watching it, but I'm not going to buy it and watch my money be lost just because I love the company and I think they have a lot of potential. And lastly, don't let your pride and ego get in the way, because psychologically it is hard to sell a stock for a loss because you're admitting that you're wrong. But that's just something that as an investor you have to get used to, the idea that if you're going to trade common stocks, you're going to be wrong many times. So why not, when you're wrong, just cut the losses quickly. Then you can try that stock again when it shows strength again, or you can move on to another stock. And one thing Bill O'Neill said was that all stocks are bad except the ones that go up in price. All right, so let's talk about setting stops. And a stop basically means it's a stop loss. It's a level at which you're going to sell your stock to limit your losses. So there's different ways of setting stops after you buy a stock. And I've listed some here that I've used over the years. The first one, which is probably the most common and the one that IBD endorses the most, is a percent of the buy price. So you might say, I'm going to cut all my losses at 7 to 8% of my buy price. And that's fine, and you could even do it less. Like right now, I'm cutting losses more like 3% on average, just because of the market conditions. And so I say here, this can fluctuate based on the market conditions or based on your profit goal. So if your profit goal is 15%, cut your losses at no more than 5%. And again, you don't have to wait for it to hit your 7 or 8% or 5%, whatever you set as your stop. You can cut it sooner than that if it's not performing right and if it doesn't look right. You can also set stops at a recent support level. So this might be a price level at which the stock has been finding support. Okay, if it breaks through that support, that might be a good place to set your stop. You could also use the buy point in the base. So if you bought on a cup with handle, you could use the buy point as the stop level. And I'll show some examples in MarketSmith in a few minutes here. You could also use a recent intraday high or low. And again, I'll show an example of this with Domino's Pizza. One thing, I got this out of a day trading book, and I don't really day trade because I work for a living, but stocks tend to find support or resistance, or they tend to congregate around whole numbers. And since a lot of the stocks that, if you follow IBD and you invest in their stocks, a lot of these are higher priced stocks. And you'll notice that around multiples of 5 or 10, stocks will tend to congregate and they'll tend to find resistance or support there. You could also use a moving average, typically the 50-day or the 200-day. You could also use the 10-week or the 40-week, which are kind of the corresponding weekly moving averages. And lastly, you could actually set a trailing stop order. What this means is that as the stock goes up in price, if it starts to come back down, you can calculate from that peak. So let's say you want to do a 5% trailing stop loss. If the stock goes up to some peak and it drops 5% from there, you would sell it. Now you can calculate this manually, or brokers can do this automatically for you. I know my broker, I could set say a 5% trailing stop order, and then I don't have to worry about it. It just, if the stock drops 5% from its peak, I'll get sold. It'll sell automatically. All right, let's go into the market analysis. So the market's been in a confirmed uptrend or an uptrend under pressure for about 10 weeks now. The NASDAQ recently hit resistance around the 5,000 level and then started to decline on increasing volume. It also breached the 200-day moving average pretty decisively this week in above average volume, and it's trading near the 50-day moving average. Now, the 50-day moving average is still below the 200-day, which is a sign of longer-term weakness. And there's still not many stocks breaking out of sound bases and making gains. So what I'm seeing is that a lot of stocks that are breaking out, as soon as they break out, they reverse. And I'm noticing, too, a lot of stocks that are gapping up on earnings reports are reversing right away. So there's a lot of profit taking as soon as stocks are breaking into new highs right now. And that's not what we want to see. You know, we want to see strong stocks breaking into new highs and then being accumulated even more. So this is part of the reason I'm taking my profits around 10% now and cutting losses at 3%. Because more stocks are running around 10-15% than the normal 20-25% that we would like in a strong bull market. So overall, it's okay to own stocks right now, but it's probably not a good idea to buy any new positions until this recent distribution settles down. And like I mentioned, it's a good idea to keep tighter stops than normal and take your profits sooner than normal. All right, we're going to switch over to MarketSmith now, and we're going to talk about setting stops, and then we're going to look at market analysis. Okay, so first thing, let's talk about setting stops. So this is PayPal. This is a stock I've been watching and trading a little bit. And one thing I want to show here is that, let's say you bought the stock around this level, around this right under 38. You can see there's been some, there's a resistance level here and a resistance level here. So when the stock broke through here on this day, this was a valid early buy point, and I did buy the stock here. What I did for my stop loss is I set the stop loss to this level right here. So this was a very tight stop because I got filled pretty close above 38. So this was a very tight stop. But really, if the stock breaks above this prior resistance, it should start finding support there. And you can see it has. It's at least on a closing basis. I mean, it broke up below that level here, but it found support and closed above it. It did the same thing here, did the same thing here. So this is one example of setting a stop at a prior resistance level. Another thing you could do if you bought it here, you could say you're going to use the moving average, the 50-day moving average. Now in this case, you can see here that the 50-day was 10% below this closing price. That's a pretty wide stop, so I wouldn't recommend that in this case. You might consider using the 10-day moving average, which is only 5% below this. If you did that, though, you would have got stopped out like right here, or certainly right here. So those are some examples of using the moving averages. I would say it'd be better to use the moving average as your stop if you bought near them. So let's say you were watching the stock and you saw it here trading below the 50-day. It broke through the 50-day right here. So it would have been totally valid to say I'm going to use the 50-day as my stop. And in this case, you'd be looking at a 4% loss at maximum. And then you would have got stopped out on this day, okay? But you could have tried the stock again here, and then if you were using the 50-day, you would still have it, and you'd be sitting on, what, about a 15% gain. Another thing you could do if you were, let's say Max Linear was another stock I bought recently, which you can see did not work out. But you could say, okay, 1775 here is the buy point in this cut base. So I bought this stock right here on this day as it broke out in heavy volume. And you could set your stop to the buy point in this base, which is 1775. If you did that, you'd have got stopped out on this day, okay? But you'd actually be pretty happy with that now that it's declined even more. If you bought this day and you were going to use a moving average, you'd probably want to think about using the 10-day right now, as that would have got you a 6% loss. Again, I wouldn't use the 50-day as my stop unless I bought near it. So let's say you bought on this day, it bounced off the 50-day. You could have bought there, and if you bought lower in the day's range, you could use the 50-day, and you would have got stopped out right here. So ideally, you're not going to get stopped out this quickly, but this is really it's really because of the overall market conditions that we're seeing this happen. One more example is Domino's Pizza. So this stock gapped up here, and it gapped up on, I believe this was an earnings report. Yeah, reported earnings here and gapped up very strongly with high volume. You can see some of the highest volume on the chart. And you could have set, on gap ups, it's often a good idea to set the low of the day as your stop. So in this case, that'd be 132.90. But you can see that the stock gapped up 13%. It closed up 13% for the day. So depending on where you bought, you could be looking at a pretty substantial loss if you set the bottom of this day as your stop. Another idea you could use is you could wait for the stock to form a kind of a short-term low, like this day right here. You could set your stop loss to, let's say, this level, 130.51, depending on where you bought here. So if you'd have done that, you would have got stopped out here. If you would have set the low here as the day, you would have got stopped out this day. And you can see this stock is breaking down pretty badly. We had a day here, broke the 10-day moving average very decisively and above average volume. And then it broke through the 50-day. This is definitely a sell signal if you had this stock. And so let's see what happens here. This might be this might actually become a good, could be a good one to watch for a short sell, since you can see this has been running for a long time. And we had a big volume down week here. The biggest down volume in a long time. So this is not looking good here. If you see this coming back up and hitting resistance at the 50-day and then bouncing off of it in heavy volume, or breaking below the 200-day in heavy volume, this could be a good one to watch for a potential short sale. Okay, so those are some examples of setting stops. One thing I like to do in MarketSmith is if I am setting a percent stop, so let's say I bought like Square, for example. Let's say I bought this stock on the breakout day right here. And let's say you want to set your stop loss to a certain percent below this. Like you might say, I want to set this to a 5% loss. What I do is I'll actually draw on the chart a line where my stop loss is. Okay, so that way I can see it. And with MarketSmith, you can set an alert. And if you right click and hit set alert, you could, let's not do that. You could set an alert at any level, and then if the stock breaks through your stop loss, you'll get notified. You'll get a notification up here. Okay, so this is also a good example of this is another good example of one where you might use a whole number. So the buy point in this base is 1478. So depending on how much of a loss you're willing to tolerate, you could consider setting 14 as a stop loss, because that's the nearest whole number. And stocks do tend to congregate around whole numbers. Okay? And you can see here, see how this stock got up to 1591. Then it got up to 1587, 1581. So it's kind of hitting resistance around 16. So it'd be totally valid to say 14 was going to be your stop loss if you bought here. So it's just something else to keep in mind. You can see here it hit 1350, which isn't a whole number, but it's half of a whole number. And you can see like this day here we hit around 14. So you'll just kind of notice that stocks tend to congregate around these whole numbers, multiples of 5 or 10. Okay, so let's take a look and do a market analysis here. Start with the monthly chart on the NASDAQ. So if you look long term on the monthly chart, and this chart goes back to 1992. We hit this prior high of 5132 back in the technology boom in the late 90s. And you can see that we were bumping up against this. And we did go a little bit above this. You can see here, one nice thing of MarketSmith is they give you these intermediate high and lows. So 52.32, we exceeded this by about 100 points. But you can see overall we hit resistance here. And this is going to be a really key resistance point over the long term. If the NASDAQ can rise above this and then start to find support here and bounce off of it, that's going to be probably a really positive sign. Now this bull market started here in March of 2009 after we had the financial crisis. And you can see that it's been running for a long time. And I've drawn this trend line here connecting kind of 3 of the intermediate lows. And you can see that we broke through this trend line last August. And it hasn't rallied back above that trend line. So it's looking like this market is potentially going to roll over. Nobody knows for sure, but you can see how we broke through here, and then we're hitting resistance at this prior level from March 2000. So you can see too, one other thing to look at is see how tight the trading was here, relatively tight on a monthly basis. Then look how loose these months are. See how the trading range is much wider? That is a sign of increased volatility and uncertainty. So given the resistance we're hitting here, the trend line being broken, the increase in volatility and the monthly range, I'm pretty skeptical right now. I would be really surprised if we were to rally up to new highs and have a strong market. Anything can happen, so no one knows, but it doesn't look very likely. Okay, so here we are on weekly chart. Actually, let's go back to the monthly. In the last month, you can see for April, we're down for the month. We're at the bottom of the range, and volume is a little bit above average. So not a very good month. On the weekly chart, since hitting a bottom here in February, the NASDAQ ran quite a bit. 1, 2, 3, 4, 5, 7 of 9 weeks up, which is very strong. And I mentioned in last month's video that it was, with that many up weeks in a row, a pullback would not be out of the question, would not be unexpected. So that's kind of what it looks like is happening here. One thing to look at, you can see that as it broke through the 40 week here, volume was not very big, okay? And volume was even low as we made the high here. And then it reversed on increasing volume and above average volume. And then this week broke through both the 40 week and the 10 week in heavy volume, okay? So this is not a good sign this week. Definitely a sign of weakness. If it does keep dropping, we're going to be looking for support around the 4,300 level and then the 4,200 level. I'd say those are the longer term support and resistance levels. And on the daily chart, you can see this big run up here. We traded above the 10-day for quite some time, and now you can see hit resistance here, broke through the 20-day, broke through the 200-day in above average volume. And you can see yesterday, April 29th, volume was really heavy, one of the heavier volume down days in a while. And we closed in the middle of the range, but we're closing, you can see we're basically right at the 50-day. We're 0.2% away. So next week is going to be really interesting to see if we congregate around the 50-day or if it breaks above or below it. If it goes back above it, we're probably going to see some tight action here between the two moving averages, as they're not too far apart, the 50-day and the 200-day. Look at the IBD 50. On a monthly chart, you can see it's down for the month and below average volume. On the weekly, hitting resistance you can see we hit resistance here at the 40 week, and again at the 40 week, and we're closed right at about the 10 week, 0.6% away. Now leading stocks are dropping in lower volume, so that's a better sign than what we saw in the NASDAQ. But again, you can see here hitting resistance, very clear resistance at the 200-day. Volume's been very light over the past couple weeks, so that's a better sign. But really, we'd want to see the 50-day trading above the 200-day and see some daylight here. Again, this is market's a little shaky right now. Let's also look at the Russell 2000. This corrected pretty substantially, much more than the NASDAQ and S&P. We had two legs down here. And you can see here rallying up in below average volume. This is looking stronger than the other indices that we saw. It's still trading above the 200-day, but the 50-day is still below the 200-day. So we'd like to see that come above the 200-day. So overall, market's not looking great right now. Let's look at some stocks here. Facebook broke out this week from a cup with handle, and you can see it gapped up pretty substantially in heavy volume. And then the only problem is it ended up closing very low in the day's range. So that's not the best sign. However, you might sometimes you can look at this and say, well, if I drew a line from the prior day's close, so if I consider the full range for the day like this, then it did close pretty high in the day's range. If you look, you can look at gap ups that way. But you can see on the breakout day, it closed just below the buy point. So that was a sign of weakness. And I actually did buy the stock on the breakout day, and I sold it when the breakout didn't work. Now it's hovering right around. It is above the buy point again. It's hovering right around it. I might go at this again. And I was talking earlier about just one point here. One thing I want to point out here. I was talking about how stocks tend to congregate around whole numbers. You can see that we hit resistance around the 120 mark, and so that's going to be a good level to watch. In fact, I have an alert there. I want to know if this goes above the 120 point. But you can see this gapped up, reversed. PayPal did the same thing, gapped up here, flirted with this prior resistance point, 41.75, and reversed and closed, near the bottom of the range. And then yesterday it gapped down. So this one didn't work out so great either. A couple of ones to watch. Amazon gapped up, did finish lower in the day's range, but it traded pretty tightly here. So another whole number we talk about, Jesse Livermore talked about something called a century mark. These are multiples of 100. And there's an old saying that if a stock goes to 100, it'll probably go to 110. I believe that's the saying. So it's a good idea to watch these, and if this breaks through 700 and it starts to find support at 700, I might buy this and just shoot for maybe a quick 5% or so gain in this, because these tend to be big levels of support. You can see here this day found support at the 600 mark almost exactly. You can see around here how it congregated around the 600 mark. And you can see here how we hit resistance around the 700 mark. So Amazon might be a good one to watch. LinkedIn also gapped up, not quite as decisively, and you can see it closed at the bottom of the range. I'm not so interested in that one. So what else? Stocks I own right now. Penumbra is one I've owned. I bought it here as it broke. Actually, I bought it here when it broke this trend line, the sloping trend line. I bought it on this day. This was a good day. It was up in heavy volume, and then I added to the position as it broke through this prior support level around 52. So I've still got the position here. You can see it's riding the 10-day really nicely. Yesterday it traded below it, but it found support. Especially with yesterday being such a bad day in the general market. You can see how the general market is trending downward, and this is hanging in there pretty nicely. So I'm liking this stock right now, and it's despite what it says here about May 9th, they're not due to report earnings for a while, in my view. March, I don't think they're due to report earnings till June, so I don't think this is right. But anyways, I'm liking this one. I'm looking next for it to break through this above this 57.37. In fact, I have a alert here to tell me that. And then I'm looking for it to break above this buy point in this cut base around 59.36. It could be forming a handle here. It might form a handle if we get a couple more days where it's trading sideways or down here. We might call this a handle. So if it forms a handle and breaks through there, I'll be looking to probably add to my position. I'll also be looking at the 60 mark to see if it breaks out of 59.36. Does it break through 60? I think that'll be a key support, a key level to watch as well. RS line is pointing up here, looking pretty strong. And on the weekly, you can see we've got finishing high in the range here, 92% of the range on above average volume. Finishing high in the range here on above average volume. Did the same thing here. Here we had a down week, but you can see the volume here on the down week is lower than all these up weeks. Here we had an up week which finished more in the middle of the range, but volume was heavy and it closed above the 10 week. And then this was a bad week here, but again, ever since then we've had some nice spikes in upside volume. So I'm liking this for now. Who knows what'll happen with it, but I'm liking it. And the other stock that I have at the moment, besides Penumbra, is TransUnion. This broke out for the week. They reported earnings either the day, probably the night before this, and I was watching this 28 level. Okay, the buy point in the base officially was down near 27. Okay, and I was watching this and drew a sloping trend line. I had other stocks I bought at the time, so I didn't buy this, which I was pretty bummed because if I would have bought it when it broke this trend line, it never even flirted with giving me a sell signal. Although I would have sold it before earnings because I wouldn't have had much of a gain here. But anyways, it broke through this 28 level really nicely. You can see it congregating around 30, that whole number. So I bought it on this breakout day, and one of the sell rules I use is that once a stock is up 5% for me, I will move my stop loss to 1% of the buy price. And that's so I don't want to let a gain turn into a loss. So this has gone up 5% on this between these 2 days. So my you can see I've got a pretty tight stop right now, and it's pretty close to it. But I didn't want to go from being up 5% to taking a loss. So if it does keep dropping, I'm going to take a 1% gain. Hopefully it keeps going. Hopefully it keeps trading tightly around 30 before it goes higher. But you can see RS is looking really strong here. RS line is at a new high. The stock's at a new all-time high. Earnings were accelerating here. Sales were steady. You can see here earnings have accelerated now for 2 quarters. Sales is very steady. The forecast for this year and next year were upgraded. Although for the year, I'd like to see a little better for next year. But on the weekly, you can see this was a wide bar for the week. Volume for the week wasn't as high as I'd like it to be, but you know, this is a trade in new highs, and here we had an up week here and above average volume, and then this week was a support week as it closed in the 61% of the range, and it found support at the 10 week. And you can see the RS lines pointed like straight up here in new highs. So I'm liking this one. These are 2 stocks I have right now, and I'm liking them right now. Okay, so let's conclude here. So if you found this video on YouTube and you're not a member of the meetup group, then you can join by following the below link. And it does require a free meetup account, which is pretty easy. It takes about 5 or 10 minutes to set up. And if you're wondering why should you join the group, files such as this presentation and other trackers and cheat sheets are available on the meetup group, and they're available for members only. The other advantage of being in the meetup group is that you'll be notified when new videos are posted or when new files are posted. So if you're not a member of the meetup group, I encourage you to join. No questions from the past month, so if anyone has any questions, please send them my way. I have gotten some nice words from a couple of our members, so I appreciate the words of encouragement. I'm glad you guys are liking the videos. So in conclusion, for future topics, I'm going to do an investing book review next month, and I'm going to talk about creating your own investing methodology. So that's going to cover your buying strategy, your selling strategy, your sell rules, your routines for daily, weekly, monthly. It's going to talk about portfolio management. So I'm going to talk about, it's a good idea to have a written trading methodology that kind of describes how you're going to go about investing in the market, and what accounts are you going to use for stocks, which ones are you going to use. Are you going to trade in ETFs? Are you going to trade mutual funds? Are you going to day trade or swing trade? So I'll talk about that next month. I'm actually in the process of making my own investing methodology. So if you have suggestions for other future topics, please shoot me a message and let me know. And if you have any questions, send me a message through the Meetup group, and I'll include an answer to your question in a future video. So I hope everyone enjoyed the video this month. Thanks, and have a great day.